Meantime, we'll turn to the commodities trade. Gold is notching its worst weekly performance of the year since last week. Copper having its worst weekly performance since 22. That's despite some huge run-ups in both of those metals this year. And then there's crude jumping today, but on pace for the worst month of the year as we kick off the busy summer driving season and await the OPEC Plus meeting on Sunday. Joining us this morning is BofA Securities head of commodities and derivatives research, Francisco Blanch. It's great to have you back. Do we expect headlines out of OPEC this weekend?
Well, Carl, look, I think OPEC is going to extend the cuts into the second half of the year. That's the most likely outcome of the upcoming meeting. They are, however, quite bullish on demand for oil, and that's perhaps a bit of a surprise. I mean, they are at 2.4 million barrels a day in terms of their demand growth expectations for 2024, compared to the International Energy Agency, which sets itself at the other end of the spectrum at around just 1.1. Remember, the base is about 100 million barrels a day. So OPEC is constructive on demand. They will likely keep the cuts and expect that prices lift a little higher.
Are you of the belief, Francisco, that Chinese demand is ascendant at the moment, at least?
Look, I think data is looking better across Europe and China. U.S. data has decelerated a touch, but it's still pretty strong, as we know. So I think the world economy is looking, frankly, a little more improved than it was maybe a few weeks back, and that's despite the fact that we've had that 100% tariff on Chinese EVs. But certainly the news this morning that China would be relaxing some of the property rules to try to clear the market, the real estate market there, has allowed for copper prices to rally today. So it's been a bit of a recovery on the red metal in the morning.
Yeah, let's talk copper, because it's been an amazing chart. This was the hot new, data center AI play. How do you determine how much further it can go from here? We were talking to Richard Ackerson of Freeport-McMoRan like a week ago, and he was talking about how severe the copper shortage is going to be given all this demand.
We are in the same camp. We think there's going to be a meaningful shortage. We are looking for $12,000 per ton as a target, and which I guess will be somewhere in the range of maybe $6 a pound. But again, the issue I think with copper right now is that it's moved a little ahead of fundamentals. Remember that consumption growth is weak, given the fact that yes, we're looking at potentially positive data points, but PMIs globally are soft on the manufacturing front. We're also seeing weak industrial activity in many countries, limited trade. So I think as producers around the world, as manufacturers rebuild their inventories of raw materials and intermediate goods, we will see a run-up in industrial metals, and copper will be a big beneficiary. Plus, then you have all the green energy spending that will support it as well. And then on top of that, the supply side is quite challenged. We think supply growth rates are going to average probably around 2% compared to demand growth rates that want to be at around 4%. And of course, that cannot go on forever. So that means prices have to be higher. And I think perhaps the simplest way to think about it is companies are trying to buy each other out. They're not trying to build large greenfield mines at the moment. And I think the best expression of that is copper prices need to go higher to encourage the greenfield spending.
Would you say that supply is more challenged for copper or for gold?
I'd say supply is more challenged for copper because remember, copper supply, we dig it out of the ground and we put it to use. Gold, on the other hand, it's an investable commodity. It's really a currency. And the majority of the gold demand comes from central banks and investors, whether it's retail or professional investors. So I don't think there's a scarcity in terms of, we don't have enough gold. I think, in contrast, what we have is maybe too much money, right? And we have too many. We've printed too many dollars. We're back to 1970, 71. The gold dollar convertibility story and how that broke down more than 50 years ago. And I think this is one of those moments where we've just printed an enormous amount of money. Inflation has been too strong. Nominal GDP growth has been too strong. And then gold prices are reflecting that, reflecting just the expansion of the nominal economy and the monetary base.
Yeah.